Well, good afternoon and welcome to HYROX's weekly webinar where we're going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson. I'm joined by my partner and colleague, Paul Tepsich, the founder of HYROX, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. If you haven't had a chance, tune into our website and seek out Paul's blogs because I think they're actually very interesting things to read, and it is very important, I think, that everybody gets as much of Paul as they can. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what has happened last week. Now, our overriding theme for 2016 is that financial markets will remain volatile. In January and early February, we saw a spike in volatility, but markets did settle after that thanks to continued monetary stimulus from the central banks on a global scale. Now, volatility is spiking as uncertainty levels are rising on a global scale with the UK referendum on remaining in or leaving the European Union. Now, the U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. At the moment, we see a growing chance of a recession in the U.S. in the next 6 to 8 months or thereabouts. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy where deflationary trends continue, leaving inflation-guided central banks somewhat perplexed. Central bank monetary policy has been at the heart of keeping volatility in financial markets lower. However, geopolitical uncertainty has taken center stage, focusing on Thursday's UK referendum to be followed by the US presidential election campaign later in the fall. Bond yields continue to decline on a global scale as investors move out of more risky assets. Equity market prices have been lower in Europe and Asia, but remain expensive in the US by our metrics. And with slow economic growth and low inflation, risk-adjusted returns remain below their annual averages. Okay, let's have a look at what's been driving markets over the past week. Volatility jumped as we got closer to the Brexit vote, but there appears to be a growing sentiment in financial markets that when putting pen to paper, the folks in the UK will prefer the certainty of staying rather than the uncertainty of leaving, and that has financial markets a little less volatile this week. And that volatility has moved back below the longer-term averages at the moment. And there is a little less fear in financial markets, and we think the best buying opportunities present themselves when fear is running high, and we shall continue to wait for those. Now, since our last webinar, our benchmark world equity index is up close to 2.5% and is now up about 2.35% on the year. The Euro Stoxx 50 index was the best performer since last Tuesday as things turned around in Europe. The S&P 500 was actually the worst performer. Now, the TSX has been the best performing country index in the developed world this year. The Canadian REIT index has also done extremely well. After such a great performance, we have sold off most of our REIT holdings, especially in light of anticipated weakness in the Canadian economy. Exposure to the non-online retail sector is not something that we are comfortable with at the moment. Well, there was plenty of volatility in our benchmark All Country World Index last week, and a breakdown of the recent uptrend from February. We see now a greater probability of downside risk, despite the recent shift in sentiment away from a Brexit. Volume on down days spiked, but was subdued on up days. The 5-year return for our benchmark is close to 6% now, the 3-year return close to 6.75%, and the 1-year return near a negative 5%. If you combine the equity and bond indices into a balanced scenario, the 1-year total return has been a negative 1.43% for a 60% equity and 40% bond index combination. It's been positive at just a little under 6% over 3 years and about a 5.37 for 5 years. Now, for a less risk-oriented 40% equity and 60% bond combination, the 1-year total return has been about 40 basis points. Over 3 years, 5.5, and for 5 years, just a little over 5%. When you are comparing the return on your portfolio, don't forget to include your fees and any MER costs. You want to subtract those out. Well, in fixed income markets, the Canadian Preferred Share Index was definitely the worst performer this week. Now, the Canadian Preferred Share Index remains in its downtrend channel and suffered a new wave of selling last week that knocked it lower by over 5% at one particular point. Now, this is an asset class that was once a sleepy, nice, dividend-yielding, fairly stable asset class, but this changed in 2013 when Canadian bank capital requirements changed. Now, last fall, in order to draw demand for an enormous amount of new supply, Canadian banks pushed dividend yields higher and the whole asset class was repriced lower. Canadian banks will likely have more supply to come to keep up with their Tier 1 capital requirements. If they raise the dividend yields again to attract buyers, any existing supply will get repriced lower as it did last fall. This has pushed up the risk level of owning these assets. The total return on this index over the last 2 years, measured on a daily basis, has been more than a negative 9%. The increased volatility in the preferred share index and the greater risk associated with them have raised caution flags for us over. It did raise caution flags for us over a year ago. It is something that should be revisited in any portfolio because of the increased level of volatility that it now carries. We do not own this index at the moment, although we do own some perpetual preferred share issues that have significantly less volatility.
Scott, could I just add that we own a couple Lifeco perpetual, not bank pref.
Sure. Yes.
A significant difference in capital requirements.
Thank you, Paul. 10-year bond yields ticked a little higher after last week's move lower, but for the moment, rates are generally headed lower and perhaps much lower if Brexit does happen and investors move to less risky assets. Natural gas was up again and gold moved lower this week. And oil did break below the band of its recent uptrend, so we're watching developments there closely. Now, on another note, a report issued this week by Raymond James analysts suggests oil may climb back to near $80 in 2017 on tightening supply and demand dynamics. So we're going to keep a close eye on what happens with regards to oil over the coming year and a bit. The Bloomberg Commodity Index continues its new uptrend, but is off its recent highs. Well, as I mentioned each week, the broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in and not necessarily in the countries. With over 50% of the companies in our benchmark domiciled in the U.S., we keep a close eye on what is happening in the U.S. economy. But first, to the political stage, where we find Clinton now regaining some ground over Trump. Last week at their meeting, the Federal Open Market Committee members indicated their expectations for future interest rate increases and have further scaled them back. March's dot plot on the left against last week's on the right, you can see that that green line is significantly flatter than it was at the March FOMC meeting. There are also more long-lasting or persistent factors that may be at work that are holding down the longer-run level of neutral rates, said Fed Chair Janet Yellen in her post-meeting press conference. It is our belief here at High Rock that an increase in interest rates in any manner will flatten the yield curve and potentially fuel the next U.S. recession, which we think is not that far away based on our metric of historical levels of unemployment. Meanwhile, U.S. second quarter GDP expectations were unchanged at 2.8% this week. And elsewhere in the global economy, we continue to monitor global debt as it reaches record highs. But after significant monetary stimulus from the European Central Bank and the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, the results have yet to show much economic improvement. Inflation still remains a chief concern, and economic growth has not emerged. Now, with just a few days to go until the UK on remaining in the European Union, the polls are showing an even race with an undecided camp of somewhere between 10 and 12%. At stake is the likely chance of a UK recession should they leave the European Union, but it also gives the anti-establishment movement all over Europe a stronger hand, which could ultimately destabilize the whole Union and the euro as a currency. Plenty of future uncertainty there if the UK should vote to leave the European Union. In direct contrast to the polls, however, the gambling odds of a Brexit have fallen quite significantly since the murder of a pro-Remain minister. And it appears that financial markets have put more faith in these odds than the polls, as the British pound, which had continued on its roller coaster ride that began in 2015, has popped up considerably in the last few days. Well, in the background, and if, as we expect, the Remain camp wins the day, we have to go back to the realities facing the global economy. Well, in the euro area, deflation remains the concern as the rate of inflation remains below the yellow zero line. The European Central Bank's target is that red line of 2%, so they will make their next interest rate decision sometime in mid-July. In Japan, deflation also remains a concern, but at their latest meeting last week, the Bank of Japan did hold interest rates steady. Meanwhile, inflation in China slowed in May to 2% from 2.3% in April. Here at home, the Canadian CPI in May fell to an annualized rate of 1.5% from 1.7% in April. Now, as many of you who recently participated in a wealth forecast may remember, we use a 2.5% rate of inflation assumption for the purposes of projecting future lifestyle costs. This is how that stacks up to the recent release of the components in the CPI. Now, of course, everybody will have a different rate depending on their consumption habits, but we think that 2.5% at this time represents a reasonably conservative assumption. But it is something that we need to monitor closely because it does have a direct and significant impact on family wealth and savings from year to year. Okay, so where do we see all of this taking us? Let's see what the bond markets are suggesting. Now, all of our yield curves steepened a bit this week, a positive sign for the global economy as the Brexit vote appeared to shift back in favor of remaining in Europe, in the European Union. My apologies. Short-term yields remain negative in Europe and Japan, however, as deflation risks still remain. As we monitor the potential for a U.S. recession, we are watching for a flattening of the yield curve, similar to what occurred in 2007. Remember, an increase in short-term rates by the U.S. Federal Reserve or a decline in long-term yields, if there is a flight to safety or a combination of both, will add to the possibility of a potential recession. Now, prior to a recession, historically, a yield curve will flatten as it did in 2007 and in 2000. Now, this process has already begun for the next flattening of the yield curve. As for equity market value, when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.3 times. The 12-month forward price-earnings ratio is currently at an expensive 16.4 times, but down from an even more expensive 16.8 times last week at this time. The equity market highs back in May of 2015, it was at 17.1. Not only are prices expensive relative to earnings, but there have been 4 consecutive quarters of negative earnings growth, and expectations show that the second quarter will be the 5th, with expectations showing negative growth of 5.1%. Now, earnings growth for all of 2016 is expected to show growth of less than 1%. It's hard to expect growth in equity markets when companies are not growing their earnings. And as we point out each week, corporate profitability, which is the gold line, tends to lag the S&P 500, which is the white line, and we see no reason for it being any different this time around. Now, the stock markets do tend to fall during recessions. So what does it all mean? Well, for over a year now, we have taken a cautious and defensive posture to investing, and it has been fortuitous for our clients and for ourselves. Remember that we invest in the exact same models and securities as you do. We remain defensive because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics that help us to determine where there might be some value, but until we're convinced that there is value, we will remain cautious. Now, with the Brexit vote on Thursday, we are comfortable to wait for developments on that front, and then next will be the U.S. presidential election, again posing great potential for further uncertainty. Cash and cash equivalents have been and continue to be important defensive assets, so we are still carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis we do at High Rock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe will add value to the long-term performance. Rebalancing on a regular basis is crucial, and this is something we meet on each week. Different asset classes will outperform or underperform at different times in a market cycle. Selling outperforming assets and buying the underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform. And this is how profitability is realized and the new cash is reinvested. We also analyze each asset class to ensure that it is appropriate for each client's strategy. If an asset class like the Canadian Preferred Share Index attains a higher level of volatility and becomes less suitable, which we discussed earlier, we will reduce our and your exposure to continue to maximize risk-adjusted returns. A bunch of weeks back, Paul identified 3 top picks for our models, and I'm just wondering, Paul, if you have anything you'd like to update us on with regards to either those or anything that you see that you'd like to mention.
Sure, thanks, Scott. Athabasca, they didn't do what I thought they were going to do, but nonetheless, the outcome was the same. So they ended up using they have a significant amount of cash on the balance sheet, and they're in a net cash position, which means they have more cash on the balance sheet than debt. They used some of that cash to pay down a bank debt that was ahead of us or higher up in the capital structure than these bonds. So they got rid of that bank debt and effectively puts us in a very senior, the most senior position within the capital structure. So the bonds rallied on that news. So we bought those bonds, I think, in mid-April at 92 and a quarter, $92.25, and they traded yesterday at par. So that was our target price point. I still think they'll be taken out in November. So it's a very low risk, good carry trade for us. Our second position we mentioned back in late April was Conexus. Yesterday we had somewhat more disturbing news on Conexus. Superior Plus is running into problems with the U.S. regulator, the FTC, on purchasing Conexus and negotiating with them on which plants they would have to sell because they will have, well, they've negotiated down to 35% market share of the sodium chlorate business in North America. Which is a pretty big give up. So I'm not sure this transaction will go through. However, when we did our work and before we bought the stock, over a year ago for some of us, we did so because we felt like there was a floor or intrinsic value in place in Conexus on its own without the Superior Plus bid. In fact, we didn't know Superior was going to buy it when we bought Conexus stock. So the stock did come off yesterday about 10% and has settled in pretty nicely now. And I think it's near that floor of intrinsic value. 30-year government bonds, as Scott may have shown, they gave up a fair bit of ground yesterday and a little bit more today. Oh, there you go. That's in a price basis, but we are still about 20 basis points from where we purchased them. Or, Scott, I'm kind of looking at the chart, but I can't see it very well, but we probably are up, I'm guessing $7 or $8 by that chart. So we still have and that was just an addition, and quite frankly, we're still, as I may have mentioned last week, it felt like they were a little toppy last week, and indeed they were. Would have been nice to take some sales, but we're still below our target weight in 30-year Government of Canada bonds. So if they sell off a whole bunch more, we may even look at adding to that position. Away from those 3 picks that we mentioned about 2 months ago on BNN, continuing to do some work. I've opened up a few new files. We did add one position in a natural gas company, very small weight and equity. That worked out pretty well. It's about 30% in a few days, and we would look to add a little bit more to that position if it comes off. So that's it.
Thanks, Paul. That's great. Thanks for the update. It's always nice to hear about some of the things that are going on behind the scenes. So that's tremendous. All right. So as we do each week, let's have a look forward to see what's coming as far as interesting news. Tomorrow we're going to get some indicators of what's going on in Japan as far as June manufacturing. We'll see Euro area June manufacturing on Thursday. And of course, the major event is the European Union referendum, otherwise known as Brexit. And that certainly will have significant repercussions, especially if the UK vote to leave the Union. So we'll be monitoring that very closely on overnight Thursday and watching markets and see how they react on Friday. Next week, not a lot in the beginning of the week. We will see Japanese May retail sales on Tuesday, and of course we have our HIROC weekly webinar on Tuesday as well. That's it for today's discussion. If anyone who is listening might have a question, please feel free to ask it now. Well, if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you think is good, what is not, and what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week, a great weekend, and don't forget to tune in next Tuesday. Until then, this is Scott Tomlinson, and I am signing off.